how long does this kind of bond volatility last, and how long does it shake companies like this?
Well, the bond volatility you're talking about is really from treasuries. So the 10-year treasury yield at the beginning of this month was 2.12%. As we speak here today, about an hour ago, it was 2.40%. So yields have increased 28 basis points approximately month to date, and that results in a loss of principal on a bond or a bond fund.
2.4% right now. Okay.
I would say this is one of the biggest questions that a lot of people who I speak to have. At what point will higher benchmark yields, the treasuries, the boons, lead to wider corporate spreads, or sort of the extra yield that investors demand over benchmark rates? And so far, it hasn't really gapped out that much, that extra cushion of yield. It's sort of held steady even as interest rates, even as treasury yields rise. That said, people are waiting for what happened in the taper tantrum. When borrowing costs rise to a certain level, people who invested in corporate debt are going to cycle back into treasuries, going to cycle back into higher rated debt, instead of going with junk bonds or investment-grade corporate bonds. And this could lead to a sort of widening of borrowing costs that go beyond just, what's going on with treasuries. And that could actually make a problem for some of these companies that are borrowing at a record pace.
Sure, and especially we've seen a lot of companies borrowing due in part to M&A, right? You don't want to repatriate the cash overseas, so you've got to raise some bonds in order to fund M&A. So does that have a ripple effect throughout the markets in something like this?
Well, rates have gone up, and some companies are sensitive to the overall rate they're paying. You look at big companies that don't need the money, like Apple Computer. They were very opportunistic and took advantage of extremely low rates. And we look at the yields that they're paying, 1.5%, 2.5%. That's pre-tax. After tax, the cost is about 70% of that. So it's really, really cheap capital they're borrowing. There's a company in the market today, Heinz, which is doing an approximately sized bond of $10 billion, and they have close to $50 billion in demand for it.
But to Lisa's point, if investors sort of shy away as we see some volatility in the market, does that yield wind up going up? And then eventually certain companies are not going to be able to go into the debt market.
Well, it really prices off of treasuries and spreads. Spreads have widened in the investment-grade market around 7 to 8 basis points this month, in the high-yield market about double that, 14, 15, 16 basis points. So it's a combination of treasury yields going up and very small spread widening.
Well, and I think that we were talking before coming on here that so far investors are still clamoring for this stuff, as you said with the Heinz deal. The fact that they're $50 billion, that it's so over allocated right now is really significant. At the same time, there could be a period of time in the future when you've got corporate credit worthiness that's deteriorating somewhat. You are seeing an increase in defaults. The number of defaults in May in the U.S. speculative grade market was the most for a month since 2009. Oh, wow. I mean, this is actually, there is some concerns about credit quality at this point that are creeping in, and you could see that trickle into higher borrowing costs that are more substantial.
And you do see that particularly in the junk market, because we have seen investors pull about $5 billion from funds that invest in the junk-rated debt market. To your point, if a non-credit-worthy company can't raise cash, do they go bankrupt, and does that accelerate?
Right. Most of the defaults were in the energy sector. And there were a handful of companies that are really challenged and struggling, and their bond prices reflect the challenges they have. They're in very low price zones.